Welcome to Recogs, the show where we learn how the world's best business operators build consumer brands from sourcing to selling, brought to you by Manufactured. This is a replay of a live webinar we did on February 8th, 2024. We chatted with Anthony Rosen from Propeller Industries, who has advised over 1,000 brands as they've scaled, and Sumeet Shah from VHS Ventures, who has also advised and invested in brands over the past decade. Without further ado, I'm going to take you to the webinar. Hey everyone, thanks so much for attending this webinar. Anthony and Sumeet, it's so great having you both here and really excited to dive into this topic. How funding your brand's ascent, equity and debt strategies for sustainable growth. Really trying to dissect, when does it make sense to use debt? When does it make sense to use equity as you're growing your brand? I'm your MC, Mike Gelb. I'm the community manager here at Manufactured. Before we get started, I'll tell you a little bit about Manufactured really quick. I promise we'll be brief. Manufactured helps brands with inventory financing and lowering COGS. A couple of use cases of why brands partner with us if they're looking for inventory financing or PO financing, or if they're looking for ways to grow their gross margins by either counter sourcing. We have a manufacturing network of over 700 vetted vendors, or to see if we can help on the logistics side of things as well. Thrilled, as I said before, thrilled to be joined here by Anthony Rosen, who's a CFO at Propeller Industries. We'll find out more about Propeller Industries, and Sumeet Shah, who's a managing partner at VHS Ventures. Gentlemen, welcome.
Thank you, Mike. Thank you for having us today.
Yeah, no, thank you so much. So Anthony, tell us a little bit about Propeller Industries and your work.
Sure. So Propeller is a fractional CFO firm. We've been around, one of the first to do this. We've been around about 15 years, worked with over 1,000 companies in that time frame, primarily venture stage, seed, Series A, Series B companies. We are segregated into verticals, and I lead the consumer practice area. We do everything from bookkeeping to FP&A, budgeting, cash flow support, and strategic CFO support. So I've worked with probably 50 or so consumer brands over the last 5 years, and obviously debt versus equity and when and how much is a big discussion in all of these cases. So looking forward to the chat today.
Cool. And some of the brands, of course, that you all work with: Olipop, Liquid Death, Crave, Zico, Farmer's Dog. So just incredible, really iconic consumer brands that you all work with on kind of all different stages. So really looking forward to hearing your perspective. Sumeet, tell us a little bit about yourself, and VHS Ventures.
Yeah. Thanks, Mike. Hey, everybody. My name is Sumeet Shah. I'm the founder and managing partner of VHS Ventures. We launched last summer, and we're a seed and some pre-seed stage-focused consumer venture capital firm. Prior to VHS, I have 15 years of early stage and later stage consumer investing and operating experience, working with private equity-backed brands for the first 5 years of my career, and then venture and startups for the last decade, helping to start 2 early-stage consumer firms, Brand Foundry in 2014 and SwiftArc in 2019. Also had a small stint at Clearco, working with their partnerships arm, where Mike and I also worked together for a hot second. But it's a pleasure to be here.
It was a dream working with you, Sumeet. I had an absolute blast. So really great times. And why I'm really excited, and why I kind of asked Anthony and Sumeet to for their time for this webinar is, I think that what's really unique is, obviously Anthony is kind of involved in the day-to-day with a lot of consumer brands, and I'm sure on the finance and strategic side. So I'm sure he has a lot of kind of thoughts around that. And then Sumeet, on the other hand, like, he is involved, of course, as an investor, investing in these incredible brands of today and tomorrow. And so he's also kind of figuring out what actually makes sense, for example, for obviously making decisions in terms of from the investing side, but also whether it makes sense for the brand, and kind of advising brands if it makes sense for them to actually raise equity, period. Which I think in today's market is like a very, very kind of useful question that a lot of brands, I'm sure, are asking themselves. Well, speaking of like today's market, wanted to kind of start there, like, and this kind of current macro market, and how does that play a factor to like this kind of overarching question in this webinar about equity and debt. This has, of course, been a really when the markets are good, it seems like it's a great time for debt and equity, meaning, it seems like fundraisers rounds are usually pretty large and you're seeing like, incredible. I also have like a newsletter and where I just kind of cover a lot of like the fundraising and like it seems like, especially in consumer, of course, we went through like a wave of, huge valuations, huge rounds. And of course, that has changed, and of course on the debt market side, with interest rates being super low, during that period, of course, the debt market, it was also like a great time for debt for actual raising debt. But of course, the times have kind of flipped now, where it seems like challenge on both sides of things. It's really hard to raise an equity round. If you're a consumer brand, not that it was easy per se when times were kind of quote unquote great, but it is a lot more challenging in this current environment. And of course, in the debt on that side of things, debt's also a lot more expensive. So how are you thinking about today's market, just from the macro landscape, in terms of whether kind of debt or equity makes sense for a brand when it comes to growth? Maybe Anthony, we'll start with you.
Sure. Yeah, I think you're right. I've been in the space for about 10 years now and seen the roller coaster highs and lows and COVID and post-COVID. And, the last couple of years or last sort of 12 months in particular has been very tough, I think, both on the equity and the debt side in the consumer space. On the equity side, obviously valuations are tighter and investors are looking more closely. And on the debt side, for a time last year, it was just completely closed from my experience. Like even companies that were growing and were profitable, firms out there, debt providers that were giving, throwing money away, were just not lending to anyone, regardless. The whole industry was sort of shut. I think that's changed a bit and it's opened up, but I just think they're much more diligent. They're much more focused on unit economics and profitability. I know we're going to talk about that later, but as opposed to just revenue growth. And I think from like a high level strategy standpoint, it just means you probably are going to have to go to more people. They're still out there. There's still a lot of different debt providers out there and different types of debt, which we can talk about. But you're probably going to have to cast the net wider. And you're going to have to really know your business, have a really good financial model, and understand sort of how much money you need and when you need it and how long it's going to last you. And I think, those are things you have to be really, really buttoned up before you go out there, and raise. And I think the other thing from a timing perspective is, don't wait until you're just about out of money. Again, this is whether it's equity or debt, right? Like the worst time, sort of that bit of a chicken and egg, like the best time to go out and raise on the debt side, at least, is when you don't necessarily need it and right after an equity round. Whereas, if you wait until the very end and you have 2 months of runway, it's not going to be an option.
No, that's a great. I mean, those are great points. I think that I think to one of your points I said earlier on the debt side of things too, that that we've seen in the past few years, is that there's become so many kind of options, especially for like early stage companies to actually go out and do debt. Typically it was only reserved really until you had maybe some type of like product market fit or like real demand for your product, where you can actually go and actually even raise debt, which is why equity raising equity rounds, you almost kind of had to do it at the earlier stage. But now there's so much kind of options on the debt side of things. Some of them have kind of dried up, but it is still quite interesting. What are you saying just in this kind of like current state of the market, Sumeet, from your peers on the equity side and consumer? I know as well, like, consumer isn't nearly as popular maybe as it once was. Although I'll be honest with you, I feel like every year, like the sentiment around consumer is like it's not popular. I feel like that just never changes. I'm really looking forward to a year where they actually say, "Hey, consumers in." But what are you kind of seeing in terms of like the current market dynamics? And I just want to throw this out there too. We want to make this as helpful as possible. So if you do have any questions, please don't be afraid to ask them. But Sumeet, over to you.
So it's funny about consumer because in the venture ecosystem, for some reason, and I still don't understand this, it feels sometimes like it's the redheaded stepchild of the ecosystem. And look, I get that the venture world really started with like software and tech and software as a service investment SaaS companies on there, and all this idea of like innovation and whatnot. And for them, consumer is something that they easily scoff at because it's just not within their space. And it's been really interesting when you go to a bigger perspective of looking at the evolution of consumer in the investor front over the last decade even from here, right? Out of the ashes of the global financial crisis, you had the direct-to-consumer boom, the Warbies, the Birchboxes, the Harrys, the Pelotons, Uber, Lyft, Oscar, Casper, Dollar Shave Club, Bonobos, etc., all launching, raising their first runs of capital. And out of those ashes, you also had new consumer-specific investment firms, within product also from there. And it was a really exciting time because we had foundational growth, you had asset-heavy organizations that were focusing on careful builds over time. And then, like with any investment trend, unsophisticated investors in the space would be coming into this where, again, these aforementioned software SaaS investors, have an asset light thesis that they think they can apply into an asset heavy industry. It's a square peg round hole. You end up with a lot of lifestyle brands being built out in the late 2010s. And as a result, had like companies that basically were raising way too much money, overvalued valuations, marketing driven, but it was a lot of like these unsophisticated investors that were clouding the minds of a lot of these founders, these great consumer founders. And as a result, it was frustrating to watch until though. And when you then had the wall of COVID happening, and a lot of these original consumer investors that have much, much larger funds because they've been very successful in their early investments, and now they have to go beyond consumer and invest in other spaces, consumer infrastructure, consumer tech, even other like aligned places like healthcare. And a lot of those other unsophisticated investors have moved on to like AI, I guess, at this point. We're in this reset right now because we allowed investors who, again, really didn't understand and like love to talk shit about consumer come in the door as the fox in the henhouse perspective to it. And it's really frustrating to have seen that happen. And especially because a lot of like the best consumer investors in the later stage side, the growth equity and private equity consumer shops out there, sat on the sidelines for the last 5 years because they're just waiting and like finding other sources of deal flow from there. So you're starting to see, and I'm a eternal but cautious optimist, you're starting to see the change coming through within the space in that a couple of reasons that people are now focusing on foundational businesses and growth again, pathway to profitability, yes, of course, but also just like sizable unit economics, like just the right mindset of building good, strong, sustainable businesses. You're starting to see a new guard of consumer investors from there. My friends at CPGD put together a great deck, actually, that I'm going to try to find. Let's see. Here it is. I'm going to put this in the chat that I think is only going to go to the hosts and panelists, but I think you should definitely share it, Mike, if you're able to. But they put a really good guide to CPG investing that's going on from last year. And they put a really good breakdown of logos of companies that we know on that end. And so what's been really exciting about that is you're starting to see, again, this new guard of firms that are just like seed, pre-seed, some Series A focus on there, 250, 500K checks that are coming in from that end, ones that really maybe have not been as well known. But what's been really exciting where it's like, again, focus back into foundational growth, new guards that are existing from here. You're starting to see, there was an article in The Information that came through where they interviewed, Caitlin Clark interviewed Ben Lehrer of Lehrer Hippo. And what he has been like having difficulty finding the right levels of consumer because like he has to think twice about every company, which is a really good thing. But then also from the responses of all people are like, we do consumer, let's chat. There's literally free marketing for you in terms of any founder who's looking for that end. So overall, I know it's a very long answer, but I'm very optimistic in terms of where things are going through. And also like, this is a big opportunity because a lot of interest rate issues came through, a lot of debt providers, alternative financing providers kind of went under over the past couple of years. It's a big opportunity if you're a debt provider and you're able to provide real value beyond capital with your assets, admittedly like a manufacturer, like a Propeller, et cetera. Like if you're able to provide that additional value from here, and I think I'd love to elaborate more later in this webinar, it's so important now, regardless if it's equity or debt, to really push forward, especially if we're going to continue towards this like next wave of consumer that's actually focusing on good companies from there.
Yeah, I mean that's a great a number of great points there. I think that, there's obviously been like a shift towards building, which we're going to get into, like sound unit economic sustainable businesses and really kind of assessing brands in that fashion. Part of the reason why I think that there's kind of been a shift, which maybe that should have been the priority the entire time, but I think that like part of the reason why like we've like maybe experienced that shift is just because from like strategics like a successful exit typically in consumer tends to come from exiting to a strategic. Not always, but that tends to be where like the successes lie, and primarily thinking about like CPG. But I think the strategics have kind of pulled back too and been like, hey, like if you're not producing like positive EBITDA, great cash flowing businesses, then like we're not interested. I think they've gone to the days of like the $1 billion, dollar shave clubs of the world that that Unilever will kind of pull or something like that, and even some of the big ones like I think like Coke has been, for example, like pretty quiet when it comes to like M&A and that sort of thing. So a lot of the big strategic kind of pulling back, and so I think that you have to build. I think that the bar used to be like, let's build like $100 million business. And that is a great, incredible bar to like look for. But I think that then I think that the question now is, okay, how did you get there? Like how, like, is it actually, are you actually producing like positive EBITDA? Is there like, are your margins like pretty good? Or is it, or is a lot of it just like pumping out through like marketing, let's say, for example. So I think there's a lot more kind of questions like they're kind of deeper into the financial statement, into it. And that's what I've kind of like seen from the sidelines. Um, I'd love to dive. Well, with all that being said, like I think that's kind of a great kind of roundup from you both on like the kind of macro side of things and like where we're at and why as well. Building like sustainable businesses has become so much more of a priority or like kind of a must have when it comes to how investors are analyzing it, and when it comes to how companies, how strategics, how companies just in general should be thinking about growth, thinking about it in more of a sustainable way, as well as with obviously with like the macro market functions. I'd like to focus the next like few minutes on debt, if that's right with you both. I'd love to like think about what are the way, just because as well, we'll kind of get to the equity side, but like would love to like think about since the equity markets not totally has dried up. Obviously, there are the Sumeets out there in the world. But how if a brand is kind of growing or thinking about debt, like when does debt actually make sense? What are the different financing options in relation to debt that are available for emerging brands? And when does it make sense in terms of like the brand kind of portfolio or the brand shape? Does it actually make sense for a brand to actually lever up and actually maybe pull the trigger on one of those options? Maybe Anthony, we'll start with you. I know that this could probably, by the way, in itself be like its own like 3-hour webinar, so I apologize. But Anthony, just like from your perspective, since you like sit in that CFO seat from so many brands, how do you think about when to use like debt, for example, or cash on hand?
Yeah. Yeah, good question. And like I say, over the last 10 years, it's changed drastically. It used to just be you called SVB and that was it. And they're still around and they're still a good option, but there's so much more out there. I think, we'll talk about equity in a second, but in my mind, like I distinguish equity and debt. Like equity is your permanent capital. Like you don't have to pay it back. It doesn't accrue interest. It's really what you should be using to like fund operating losses and growth in the business and marketing and payroll and sort of fund your growth from that standpoint. And debt and different types of debt can be used for different things, and they're used for more specific purposes. So in my mind, I have sort of like 3 or 4 key like categories of debt. You have the traditional SVB type venture debt. So that's term loans, 4-year term loans, and those really are like runway extenders in my mind. So those generally are going to come almost always right after an equity round, and that's the best time to go, and that's almost the only time you'll get that. Within a couple of months after raise. And there's some percentage, used to be a higher percentage that they would give you, but it's still some percentage formula that they'll give you. And that's a runway extender, usually very light on covenants, and low interest from an SVB or HSBC or JPM or the like. Then you've got your ABLs. And so your asset-backed line, that's from the likes of Dwight or Assembled Brands or folks like that. And that's more like working capital specific. So for my mind, inventory and accounts receivable. So these are specific businesses that are heavy on inventory and heavy on AR. Maybe you sell to Target or Walmart and you have long payment terms, or you are growing your inventory heavily, or you're a seasonal business. And these is really meant to be like a line or revolver that you draw in times of need when you need it, but then can sort of pay back over time as well. Like where companies get in trouble is when they use the ABL. I mean, it happens all the time, to fund operating losses, and they really become like a loan. And you're always going to use it a little bit for that, and the banks probably know that. But if you're using it like permanently as a loan that's just sort of outstanding at $2 million and it sits there flat, then it's not really being used for its main purpose, which is sort of seasonality and growth of inventory. And then the last is
by the way, if you do that, turn it up. But if you do that, then essentially, the interest that you're going to be accruing and paying has just become so much more expensive. It actually doesn't make sense at all to actually use it.
Exactly. And then the last, which is pretty recent, the last couple of years, is the revenue-based financing. So that's the Shopify Capitals, the Wayflyers. These can very quickly become drugs. You can get very addicted to them. But they can be, in certain circumstances, in my mind, good. They're really for me, they're bridge financing. So like a short-term bridge to a convertible note raise, to some sort of a seasonality thing that you're going to get through it in 3 months. Like it can be useful, but the tough things about those is they generally are never going to quote an interest rate. They're going to say it's like a 6% fee. And you're going to think, great, it's 6% interest, it's so cheap. But if it's a 6% fee and you pay it back in 2 months, you actually calculate the ARR there, and it's really expensive. And I've seen it so many times. I have clients that get sort of addicted to it because it is the easiest. You literally click one button now in Wayflyer and Shopify, and you get the money. And that's why it's a drug. Like you get addicted to it, and they take a percentage of your revenue and your sales every day. And if you keep doing that over and over and over again, it becomes very, very, very expensive. And generally, it's not going to get you to profitability. You probably need some sort of equity or longer stage debt. So again, short instances and in certain instances, I think it's a good solution, but not long term.
But for inventory, like, since I know that we kind of like went down this a little bit on the inventory side of things, like raising like an equity round. Let's say you just got like a huge PO, let's say from like Target, and you're gonna be like hundreds of Target stores, like fantastic. Like that is not really like the time to use to actually go out and try to raise like an equity and be like, hey, like investors, look at us, we got like this like PO from Target, right?
No. I mean, investors hate that. They don't want their equity to go towards that. And that's a totally fine use for the debt. And again, it's short term.
Yeah.
The best solution there, I always tell people, is to try and negotiate better payment terms with suppliers, and then you don't need debt, right? Like as you grow and as you become more profitable and as you have sort of longer term relationships with a supplier, you should be able to go from 50% deposit to 25% deposit to no deposit to 30-day terms to 60-day terms over time, and then that helps party working capital. But otherwise, there's people out there that will sort of PO financing, factoring, that will sort of get you over. If you have $1 million PO, that will help you factor that or buy the inventory for that, and that's a good short term use of. Yeah, for sure.
I guess going the other way though, if you did, for example, pay your suppliers up front for all the inventory produced, couldn't you also say, hey, we're obviously paying you all up front. What can you maybe do for us when it comes to on the margin side of things?
Yeah, it's a trade off. Like you should be having,
Yeah.
it's sort of like a price versus work versus timing discussion. And in the perfect world, they're giving you that choice. So I've seen people like Target do that. They'll say, we'll pay you 2% net 30 or 3% net 10 or something like that. And it's doing the same thing with your supplier. You're deciding what's more important to you, margin or cash. And for most startups, it's going to be cash. Like initially, it's not, you're willing to sacrifice 1 or 2 points of margin to get working capital. But then as you scale, ideally, you are getting that margin back.
Got it. That makes sense. We actually have I'll go to Sumeet first, and then I'll ask this question from this anonymous attendee, which is a great question.
Yeah.
Sumeet, how are you thinking about this in your terms? Obviously, you're probably seeing like hundreds, if not thousands, of brands that are kind of pitching you on the equity side. Are you also like asking brands in terms of like what do you actually want to use that capital for, and what actually makes sense to you, and if they actually want to use, if you actually feel like it actually makes sense for them to actually use debt over equity, how do you think about this question when it comes to what actual debt options make sense for that company?
Yeah, I as absolutely part of my diligence is asking about use of funds, right? And I want to definitely look through a buy general sector of like product slash tech, hiring slash team, marketing, and a kind of X factors that are specific to them. But I want these companies to be specific with me in terms of it, because when they're walking me through what the use of funds are looking towards, it gives me a couple of perspectives. One, in terms of that, like they've been actually doing the back of the envelope calculation of how much they need to raise as per, again, for a seed round, like 12 to 18-month runway and what it actually means to be used for transparently. But also, like, if there are some of the things that they are looking to raise the capital for more for the present versus the future, that, okay, we can find the right debt provider that also then provides true value beyond capital, like an inventory financing shop, a true revenue-based financing shop, a other kind of like key loan item or factoring shop and whatnot, that can help a lot with investing and financing the present on that end. And that's something I do want to think about as well. I'm particularly when it comes to finding the right debt provider for potential companies and for current portfolio companies as well. But again, I really stress about that opportunity of like about capital exists. Like, what are you actually able to do for the company itself on there, and also even kind of like tools and partners that you can look through on top of it. I raise that for two reasons. One, because it's an important partner for us, because it has the ability to help fund for any of the day-to-day operational things, any things that might come up for the company out of nowhere. And also for the purpose that venture firms are starting to pare down in terms of their teams. More and more firms are also paring down on their platform teams as well, which are supposed to provide that value beyond capital on the equity side. And so if you're a debt provider, right, you're able to help on that end, that is something that's incredibly important. Like Mike and I were specifically working on that actually during our ClearCode days back in 2022. And the idea was to provide the true resource library network. And you're starting to see that with even other kinds of service providers that are helping founders, the cap table management, back office, and fund administration systems. Like Carta is the prominent one, but what the guys at 10 Key Labs and Mantle are doing right now. Disclaimer, I'm helping them out on the partnership side, on the side, but they're an incredible organization that helps with all three systems. But more importantly, they're a great example where like we're building out a whole partner network on there. And more organizations that are also working towards it. Again, going back to the debt side of things, it's such an important tool to have. And so, yeah, like I can't stress enough to also the founders who are listening to this that be transparent about where you're looking to and raising your capital of use of funds, not just for the fact that like it is important for us on our own diligence as venture investors and equity dollars, but it also helps you establish if it's the right partner that you want to look through on a potential investor in general, equity or debt on top of it.
Yeah, no, those are. Go for it, Anthony.
No, I was going to say, like, talking about the use of funds, I think it's just so key to have a good financial model and forecast to understand what the next 12 to 24 months look like. And if you're really early stage startup, of course, it's going to be uncertain and there's a bit of guesswork there, but you can't really answer the question of like, should you be raising equity or debt and how much equity or debt unless you have some idea of how much you're going to need. And like Sumeet said, like what's going to be used for what.
Yeah, no, that's a great that's a really good point. I mean, understanding like in terms of the breakdown in terms of your own expenses, inventory, marketing, is it hiring? Are you going into a retailer, nationwide and to actually you actually need like a sales team or you need actual people? Like maybe for hiring might make more sense on the equity side to actually raise for that instead of on that side of things. But on the inventory side of it, like as a line item, maybe all that inventory makes much more sense for debt and like and the various different options for it. So it's really kind of understanding on at each line item for your business what actually kind of makes sense, whether it's equity or debt. We have this question, which I think is a really good one. For a startup company, when is the right time to pursue debt options? What is the right threshold, and should risk profile weigh into the equation, or should it? Oh, Sumeet answered it. 1 second. Or should it be left to the lender's discretion and diligence? Anthony, we'll start with you on this.
I mean, when it depends on what your model and forecast is saying. I mean, generally, I'd say earlier rather than later. Like you want to raise the debt or equity, like again, debt following an equity round. When you have more cash in the bank is when it's going to be easier to raise both of those. And generally, what I tell people is raise more rather than less, because it's always going to be more. You're generally going to burn more than you think you're going to burn, and it's you're going to want to extend that runway as long as you can. I think on the risk profile, that's a good one. I think it's very founder specific. There's definitely some debt options out there that require personal guarantees or that kind of thing. A lot of them don't, and most of my clients don't want that. But sometimes you can't avoid it, and some founders are willing to take that risk. And then that's going to be a personal decision to them, whether they're willing to do that. And then on the risk side, for the company as a whole, it's really about we'll probably talk about this in a few minutes, but the terms is really like looking at the covenants, right? Like if this is like a covenant light or no covenant, then and the amortization or payback period is over a really long time, then it's less risk. But if there's EBITDA covenants in there that you have a chance of tripping in 3 months, and then in theory they could default and call the debt and literally shut down your company, that's a huge risk. So I think that depending on the profile, now the Shopify Capitals of the world, that's not, they don't have those, right? But I think that certain types of debt that have these covenants or other things in there that create a lot more risk.
Yeah, that's a great point. I think it's also being in line or really kind of understanding as well on the same page with whatever debt provider you go to in terms of what your expectations are or where you want your business to be. Like I remember, and I know I told you this story. I was at a lunch, last month, and one equity investor was telling me how was how one company they as I think part of the deal with the debt provider was they wanted to grow at a certain rate every month, a certain growth rate, and that company had to pull back growth in order to kind of optimize for profitability and to get profitable. Which so many companies, by the way, are doing that right now, or having to do that, and they did. And they were actually successful at getting profitable, but they tripped over that covenant, and actually that debt provider actually called them on their debt, and the company went bankrupt. Even though they kind of had to do that in order to actually sustain business. So it's a little bit kind of contradictory there. So really being kind of like in like step on step with in step with whoever you're partnered with. That goes the same with also equity too, right? Understanding when you're actually raising capital, what their expectations are as well in terms of what the hope is in terms of like your growth rate. It's obviously like it might not you be able to meet those expectations, but having kind of conversations too when you're actually are going to make a change or are going to make a pivot to really understand obviously where they would be if you actually went down that rabbit hole. And Terrence, we will get to your question 1000% in a moment. On the debt side of things, what are some? I mean, I know we talked about covenants, and maybe we already talked about this, but what are maybe debt terms that companies should watch out for? Or maybe Anthony, as you like see, a lot of companies in your day to day, like what are maybe some debt terms you're like, ooh, like that's kind of odd, or I'm actually not going to I'm not going to go with that because that's just that just doesn't make sense.
Yeah, I mean, other than the covenants, it's all the
Yeah.
myriad of fees that they like to throw in. So, the closing fee, the facility fee, the unused facility fee, the prepayment fee, um, all those different fees. Warrants, obviously, a lot of them put in warrants. Um, it's a trade-off. The way these lenders think about it is they are looking at it all in. They're looking at the fees that they're going to make. They're looking at the warrants, and as you negotiate with them, I think you should keep that in mind, and you should depend on what's more important to you. If you're willing to give away more warrants, they may be willing to do a slightly lower interest rate or a slightly lower
Mhm.
fee. Or if you're really like you're bored or whatever, you don't want to give away warrants, you're probably going to have to give up a little bit more on the fee side. So, and then the last thing I'd say is for the ABLs in particular, it's really looking at the borrowing base. So, meaning like what percentage of inventory and AR are they going to lend against?
Mhm.
This could be anywhere from 50, 60, 70, 80%, but that makes a huge difference. If they're only going to give you 50% of your inventory, you have to keep that in mind. And there may be another lender out there that's going to give you 70% of your value of inventory, and that makes a pretty big difference. So just looking at that term, I think is also key.
Yeah, no, those are great points. Sweet, do you have anything to add?
No, Anthony, you kind of nailed it right on the head. Honestly, nothing to add on there. That's perfectly said.
Um, cool. How well, I think we already covered it. When a let's say a company, well, just in case we didn't, let's say a company has cash, like they actually have, quite a bit of cash on hand. Um, does it actually make sense in both your in both your views to actually use that cash and kind of put that cash to work, or actually and maybe use that cash for inventory versus actually use it for debt?
I want to hear what Sumeet says before I go on.
I jumped off mute immediately from here. So it's funny you asked that. Uh, Part of our diligence that we do at VHS Ventures is to do a liquidity ratio analysis, but basically also using it on stress testing purposes. So basically what I mean by that is, and we're recording this, so I'm actually literally I'm not gonna share my screen, but I'm pulling up my financial analysis master in terms of when I look at companies. So I'm gonna look at historical and potential revenue targets and everything on the P&L. So gross net, COGS, gross profit, operating expenses, income, etc., on everything, and an employee comp as a percentage of the total operating profit on top of there as well. And or sorry, gross profit specifically on there. So I'll look at a lot of that within the P&L from there, and I want to actually understand where the sources of funding are and the sources of revenue and everything are kind of broken down from there, so I can also track that out. But when I think about it, it's my financial stability analysis, the stress testing, looking through balance sheet, current assets and current liabilities primarily onto there. Understanding again AP, short-term loans, credit card debt, understanding long-term loans and interest expenses too, but like really, your typical current assets, cash, AR, inventory, etc. Because I want to do a lot of pieces, looking at the amount of working capital is left, looking at the actual company's monthly burn, looking at the company's runway in general, what it has by the cash itself, but also looking at current ratio, quick ratio, cash ratio, debt ratio, and interest coverage ratio on top of it. Those are the 5 key ratios that I personally look through as well. And, you could easily look up the breakdowns of like what those ratio targets should be from there. And that will also determine for me in terms of like in regards to how much company has in terms of free cash between how much it is also having an inventory and AP, like how much is locked up into it. It also showed me just like how mindful they are in terms of managing any of sort of that liquidity from there. I also look at cash conversion cycles, days sales outstanding, days inventory outstanding, days payables outstanding, and the operating and cash conversion cycles, because I really want to understand from a general level, right? Like how quickly are you actually changing your inventory into real revenue on there as well? So to answer your question as a short level, Mike, like I am very nitpicky to understand like how you're actually being as efficient as a company. And that will also determine like, look, that's not going to be an ultimately judging factor for me on a success of a metrics there, but it really helps break a lot of systems where there's like you break through a lot of the talk that you'll get through some founders. And it's fine if you feel like you're talking a big game from it. You just really got to back it up with the actual data from there too. I had a conversation with an investor who I'm looking for a beauty brand, and she was like, it's so funny. You're the first investor out of even the current cap table who's asked for a balance sheet. And I'm just sitting there thinking like, who on earth are you dealing with right now on there? But another story for another time. So to the founders listening to this and those who will be listening to on the recording end, like, please don't fuck with us on that end. Like, we don't want to have to go to that point where then everybody loses. Like, just be mindful about that. Historical, projected financials on P&L, balance sheet, cash flow, and also any other useful data in terms of sources, revenue, and breakdowns from there. Like, you're an asset-heavy business. Just treat it like that.
Yeah, I think that your question about what to use the cash for is one that I have with a lot of clients. I mean, in some respects, it's a good problem to have, obviously, a first world problem. Like you have plenty of cash, what do you use it for? And most of my businesses have very little AR because their primary channel is direct to consumer. So we're really just talking about inventory. Like if you are a business that is high AR in your premise and high inventory, that's a separate thing, and you're probably going to need some sort of an asset, an ABL to grow. But businesses that don't really have AR and are just dealing with inventory, if you've raised an equity round and a decent enough seed or Series A, and you're sitting on, enough cash in the bank, and again, goes to the point of you have a financial model, and the model says you have runway through the next 12 months. There's really no need. Like, why would you go out and get debt to finance your inventory to pay back 60 days later and just pay interest for no reason to have a slightly higher cash balance, right? If your cash is already high enough, and again, that's a broad generalization, but it depends on how much your cash is and what that runway is. But in a situation where you truly have the runway, I personally don't think it makes sense to go get debt and just to have a slightly higher cash balance. Now, if that runway is slightly shorter and your buffer is slightly less, and you think there's a chance that you may burn more, that's when it goes back to my point I said earlier that the time to get debt is when you have more cash on the balance sheet. It doesn't mean you need to draw it down. Especially the venture debt, generally venture debt, you sign a term sheet and then you have 6 to 12 months to draw it down. So exactly. So you don't want to draw it straight away because you're just going to be paying interest on it. But you may draw it in a year. You may be like, okay, actually, I've burnt more than I've expected. And I've seen this before with clients, and where I tell them, go get venture debt. If you raise a good Series A or Series B, go to SVB, go somewhere, go to JP Morgan. It's very low. It'll be low cost. It'll be easy. You'll get it. It's to actually sign the term sheet in docs will cost you, I don't know, 10 grand or something in legal fees and whatnot. And maybe you never use it. And it's just a safety net. And it's cost you almost nothing, and it's worthwhile. But I've had cases and clients where they have used it because they've ended up burning more than they thought, and they needed to draw it down. And so better to have that safety net.
I thought for venture debt though, I thought that you needed to draw it within 6 to 12 months period.
Yeah, well, I'm saying 12 months. So, but don't draw it straight. You sign, you get a term sheet, you get a facility in place, and then you draw it in month 12.
Down. Okay, got it.
You draw it down, so you're not paying interest for 12 months. So if you're sitting on,
you're using the cash, and then you're okay. Got it.
Yeah, but you've signed the debt, and you have it available. When your cash is stronger, rather than waiting 12 months to go out and get it, because you're not going to get as good a debt. Because again, this is really talking about venture debt in particular. It really needs to come right after.
Yeah, I mean, I see your point when it comes to D2C or e-commerce businesses where you probably don't need to hire that many people, right? In order to actually run these businesses, in terms of where you're actually spending money on, probably you're going to obviously have marketing costs. So of course you could use the cash for marketing. I think, and as well, obviously you could use that cash for inventory. I think that for retail businesses that have kind of cash on hand, because you kind of need to kind of hire teams when you actually do expand, whether that's to do samples, for example, in store, and manage also those relationships with those retailers. You can spend the cash for kind of making those kind of key hires and kind of as you expand, and so then you can use debt to actually fund the inventory. But of course, e-commerce, you don't need to actually hire too many people, so that's kind of the beauty of it.
Mm-hmm.
Let's get to Terrence's question, because I know that we're actually almost out of time. This is really zipped by super fast. For Sumeet, what are the key KPIs you look for in early stage consumer brands, as well as key revenue benchmarks a brand should hit before pursuing a $1 million round?
So the bigger question about, because you're very specific about the amount that you're looking to raise, I think it's also just really justifying why raise $1 million. I mean, it would probably be the assumption that you're raising. I would change the mindset to your first institutional round, your first equity round that's institutional driven. Because I would say 500K or less, or even really 400K or less, should be also across your friends, family, followers, some of your angel rounds on there as well. And so I'm going to change the $1 million round to your first institutional round in terms of the language on there. For us, we will start looking at companies that are basically doing somewhere between 50K to 100K MRR, which then, or I should really say actually not MRR, but truly monthly revenue. That really translates to a potential $500,000 to $1 million ARR. Because for us, the revenue multiple that we look through on our evaluations is around 3 to 3.5 times, which is pretty healthy in general from there. So what that means is if you're doing $1 million in top line revenue, we expect your post-money valuation to be somewhere between 3 to 3.5 million when we're going to be looking to invest on that end. You can do the numbers in terms of the equity checks and whatever that you end up raising from there. But that's the first kind of benchmark that we look through on revenue benchmarks that we get comfortable with on seed. Pre-seed is a different story. It's a very selective process for us in terms of the more founder-driven opportunity, especially if we're looking at companies that are pre-launch and pre-revenue. For key KPIs, I already mentioned that 3 to 3.5 times revenue multiple that we can feel comfortable with in terms of growth. But also ultimately, we want to take this company to a point where we are within our 3 to 5 years of our first check, the company can hit 10 to 25 million in top line revenue. Profitability is obviously paramount on that end, but our maximal net loss that we feel comfortable with is about 10%. So net income negative or net loss on that end. And the reason I say that is because, and also to the point that you're mentioning, Anthony, when you're able to get to that time frame, or that revenue growth, and provided your cap table is relatively clean, your valuations are also in a good place on there, you open up a lot of doors in terms of where you can take your future capital, whether it's taking an M&A deal from a strategic, taking a bolt-on acquisition by a private equity-backed company, taking on a private equity or growth equity investment from there in a majority stake on there, maybe potential secondaries out there, but you open up a lot of those deals from there. During the lifestyle brand boom that I mentioned in the last part of the 2010s, valuations were so out of whack that strategics and growth equity and PE firms just stayed away. They stayed on the sidelines. That's why they'll look for maybe picking companies up through pieces for scraps later on when things basically crash. And that's what happened over the last couple of years. And so if you're really looking to value your company and grow it the right way, and again, this is from a VHS perspective, but that is just so important to really look through how you're looking for that pathway. And I can go into data in terms of CAC LTV, and I look a lot actually less in terms of that and more about a company's AOV multiple. What that means is the average order value as a multiple of lifetime value, and ultimately what kind of company are you? If your AOV multiple is low, meaning that your average order value is $100 and your lifetime value is $150, you're a company that's definitely more discovery heavy, more acquisition heavy on it. That person's probably not going to buy much more again, or it might be something they may not buy consistently, like a Casper mattress. It's fine. You're a company that also focuses more on discovery and growing that all end and how you're responding to it. Or if your AOV multiple is high, meaning you're $10 and your lifetime value is 200, right? It's a 20x on that end. So your person's going to buy product at least 19 times more. That's something that's truly a necessity product. It's a great company to invest in, obviously, on that end. And what is amazing to me about it is that both kinds of companies are successful. It's just ultimately also how you're managing your internal systems, marketing systems, growth systems, your manufacturing and sales strategies that also match there as well. So that's just the general level, again, from a VHS perspective, but also that growth mindset, I think, is also going to help companies just get to the right places where you are really in control of your own destiny 3 to 5 years from now.
How about you, Anthony? As you're advising companies and looking to raise, what have I guess you've seen in your seat, which is very unique in that you've advised and work with many consumer brands on a day-to-day basis. On the earlier side of things, what have you seen in terms of the benchmarks that if a brand wanted to raise $1 million that they kind of have to have in today's market?
I think I sort of agree with Sumeet that $1 million is on a little bit of that cusp of you're probably raising it from small, angels, friends and family, small firms. The good news about those is that they're less looking at the metrics than a professional round. I think that being said, I think the people who are looking at and assuming you are doing this for sort of institutional round, as you said, it's all about profitability and capital efficiency. And I think people are looking at the LTV to CAC ratio, the payback, first order profitable. Again, this depends on the type of business, like Sumeet said, whether it's a subscription or non-subscription. But are you profitable on your first order or not? What's your your actual contribution margin? I think EBITDA profitable is great, but if you're an early stage business, you're not likely to be EBITDA profitable. But do you have a strong contribution margin? Is your unit economics, your gross margin, your contribution margin strong? And do you have a path to improve that as you scale by whether it's launching new products, increasing prices, getting cost reductions, or efficiencies around logistics and supply chain and things like that. That the investors that my clients are talking to and are like me, they're like very laser focused on these metrics. And I don't want to give like a number because it really totally depends on the type of business. So there's not like one specific number I think I could give, but those are the same metrics. And if it's a subscription business, it's just all about retention and churn. Like I have a sort of a Series B level subscription company, and that is literally the metric that the board cares about: subscription, retention, churn. Month 1, month 12, month 18. Like that's more important than anything.
No, that's no, I that makes a ton of sense. Obviously like have a deep kind of understanding of your metrics, who your customer is, and also like to Sumeet's point, is this a product that you would maybe buy once, or is this a product that, or a couple times, or is it a product that you actually have like repeats, they're actually seeing like substantial like
Uh-oh. I think we
Oh no.
Mike got frozen. Oh no! Our own host got frozen in the middle of it. It's a great photo to be frozen. As he kind of fixes his situation, I'll take quick charge on here, but since I only know we have 6 minutes left, to the rest of the panelists or the rest of the attendees in here, please also send other questions you may have on the Q&A side of things. And otherwise, like, we can also kind of just work towards what we're excited about for the future, as well from our perspectives. But feel free in the next couple of minutes if y'all want to write. Oh, and we officially lost him. But yeah, if you have any other questions also in the Q&A side of things, feel free to write from here as well. We would love to definitely see more that you guys may have. Otherwise, we can also then work on wrapping up from here. Oh, got a Q&A. Can you describe your perfect DTC business? Oh man, Anthony, I'm gonna let you take that one first.
God, my perfect DTC business is different than I think they want to know from you because you're the investor. So I mean, yeah, my perfect is one that has good fundamental unit economics, good repeat purchase behavior, good LTV, like a solid LTV to CAC ratio, is lean on the OpEx. Like I have a broad range of companies, people who have raised $100 million and people who have raised $1 or $2 million. And I like the people who are super bootstrappy and lean and founders that do a lot with less. But I think they want to hear from you.
So I agree with everything. Oh, so Mike Gelb apparently lost power. So poor guy. Gotta love some LA issues. My perfect DTC business, which I think is actually a great question for us to finish up on. I echo everything that Anthony is saying in terms of healthiness, but I also, to me, ultimately, like as a seed investor, I'm investing in people. And I'm really expecting to invest in founders who are also very evolutionary, meaning that they will grow with their business. They'll consistently keep leaning on their customer and learning. Successful consumer brands, let alone direct consumer brands, are ones that quantitatively and qualitatively understand and analyze their customer's journey. Quantitatively in terms of sales and revenue and everything on that end, but qualitatively through ambassadorship. And I think it's really important to recognize that where like a company's LTV might not be significantly high compared to AOV, but if it's also a position where it's like your customers are so loyal, admittedly, to the space, you have an opportunity to like drive the companies and customers forward again through those ambassadors from there. So a founder that really understands that level and is working through there and also really owns their kinds of role and responsibility, whether they're more operating driven or marketing driven and whatnot, it's really important for me. Like that helps really a good DTC business. Besides NPS, CSAT, reviews, and repeat percentage, what's a metric that describes product satisfaction?
I mean, that's most of them. I think the only other quick one that came to mind is return rate. So
Yeah,
like
sure.
your return rate, and again, this is totally going to depend on the product. If you're selling swimwear, you're going to have a lot higher return rate than if you're selling pots and pans. So there's not like one return rate number, but a low return rate is by definition generally going to mean product satisfaction. But yeah, NPS CSAT, reviews, repeat percent, LTV, which I guess is captured in repeat percent. Yeah, I think
Yeah.
that's
I mean, I mentioned about cash conversion cycles earlier, and that's about days sales outstanding and days inventory outstanding in there. Like, I'd love to understand how your inventory actually turns from there too. So inventory turns ultimately from that, but also in collaboration with the cash conversion cycle. So that's one for me. Um, Churn, we talked about that, returns. Also, if you're a subscription business, if you have a subscription to there, I really want to understand monthly subscription rates and rankings from here. I really would love to understand like what's actually working across from that. Again, as an investor and as probably a founder as well. But that's how I would look through. Okay. So I know we're literally right at the last minute here. And so Anthony, I'll just pass over to you, and we'll sign off for Mike. Oh, wait, I think we got Mike back. All right.
in time. Yeah, look, my closing thought is just that debt, while the markets were tough for the last couple months, I do think they are opening up a little bit, and I think there are a lot of options out there still. Some of them went away that previously existed, but there are a lot of people out there. You just have to sort of find them, talk to your other founder friends and people in the community, and talk to them. Have your sort of unit economics and know your numbers, and be buttoned up, and it's out there if you need it, and just go at the right time. Don't wait until the last minute to go out and try and raise debt.
Yeah, I agree with you and echo a lot of what you're saying there too. Oh, Anthony, or Mike, we'll pass it over to you too.
Sumeet and Anthony, this was so much fun. Thank you both so much for your time. I certainly learned quite a bit from both of you, and I hope others did as well.
Absolutely, Mike. Thank you so much for pulling this together. And it's a very optimistic future. And, to the founders who are listening through this, it's going to be a good year. All right. Thanks, everybody.
Everyone. Bye.
I hope you enjoyed the webinar. I hope it was helpful for you as you're growing your brand. If you enjoyed this and you want to hear again or replay the parts you missed, you can find recasts of our webinars on our website at manufacturer.com or on our YouTube channel. Be sure to like and subscribe and get alerts whenever there's new content available. Thanks for listening.